Nobody seems to be noticing what is currently happening to crude oil, as the indicators that signaled the last few crashes are currently firing again. And so, to understand the latest price action of this commodity, we have to take a look at the most important technicals, fundamentals, and also macroeconomics. Let's first have a look at the technicals. We have seen the reversal here at around $55 per barrel. We have seen the beginning of this new bullish trend here with this blue trend line. We've seen that volume delta has been quite neutral, but we've seen a bearish signal here at the RSI, where we've now actually broke to the downside here below this moving average in yellow. And so from the technicals, we do have seen some bearish factors in play. We have seen, however, no structural breakout here at this chart. We have seen no invalidation of this trend line here. But to actually understand the underlying factors that are driving the crude oil price here in the future, we have to take a look at the macroeconomics and fundamentals and the past few cycles, because those are the ultimate drivers: the monetary policy, the fiscal policy, and the macroeconomics in general. And so if you like this approach of taking a look at the past cycles and learn from them, please make sure to subscribe to our channel and like the video so you don't miss future videos. Now, as you do see here, history is repeating. We do have opened up the DXY, the dollar index. We've opened up the gold to oil ratio, and we've also opened up the copper to gold ratio. And let's just go through the examples as history actually repeats. We have seen here previous to the great financial crisis that crude oil has actually been trending higher. And as the crisis hit, we've obviously seen it crashing down. Why did it happen? Because obviously we've seen a reversal happening here to the DXY. During this phase where crude oil prices actually moved higher, we've seen the DXY move downward, we've seen the dollar weaken. But initially, as we've seen that happen, as we've seen the crash begin, we've seen the dollar actually consolidate and then trend upwards. We've seen it strengthen. And we've seen that actually coincide to a reversal not only here at the DXY but also at the gold to oil ratio. In other words, gold obviously outperformed oil prices. We've seen that gold actually crashed slower or less significant than we've seen it happen here to oil. At the same time, we've seen that the copper to gold ratio has already been trending lower. We've seen that gold actually outperformed copper for quite a while, but obviously as the crash hit, we've seen that to accelerate. We've seen gold outperform copper more significantly. Now, obviously, quite similar things happened in those instances. We've also seen a big crash happening here to crude oil after 2014, but we haven't really seen a big bullish trend before it. But we've also seen quite similar things happening to the DXY after the crash started. We've seen that it actually appreciated, and we've seen quite similar things also to the gold to oil ratio and to the copper to gold ratio, which also actually behaved exactly as it did here in 28. Obviously, quite similar here with the COVID crash, but obviously as well as here in 2014, we have not really seen a big bullish rally preceding the crash. We've seen more or less a consolidation, as we've seen in the last few years. It currently looks a lot like the period before the COVID crash actually happened. We've seen that long stretching, a bearish trend here now at the crude oil prices, quite similar to what we've seen happen here before the COVID crash. We've also seen that the gold to oil ratio spiked to the upside previous to the crash. We've seen that the dollar has actually been quite stagnant at this time, so we do not have this correlation to history. But we've seen the copper to gold ratio also behave quite similarly. We've also seen this moving downward as gold actually outperformed copper, which we are currently seeing as well. We are currently seeing exactly those indicators showing the same things as to previous crashes. We have seen that gold outperformed oil. We have seen that gold outperformed copper. We have seen that the dollar has actually currently retested this historical trend line here, where it historically actually reversed from to the upside. And those empirical evidences do make us quite conservative concerning this commodity. We do believe we can see, especially in those late stages of the liquidity cycle that we're currently at, we can see some bullish pressure actually regaining strength, as we've seen in the last few weeks. And so this is not necessarily the end of this long term consolidation that we've seen here now since April of 2025. And we will initially have to break below this support level at around $55. We believe it's just a matter of time. We can obviously see this rally here to continue at crude oil, but regarding this recent breakout to the downside here at the RSI, this is also already looking quite bearish. You have to understand the following. We do have cycles where liquidity is expanding and contracting. And when you do see that cycle go to the downside and liquidity and credit and the money supply is contracting, that is always coinciding to a weakening price in every asset class. Gold is crashing, oil is crashing, silver is crashing, and before this is actually happening, you tend to see those inflationary booms. Now, the fact is, we haven't really seen it here previous to 2020. We haven't really seen it in the past few weeks, but we've seen it happen to gold and silver. And so there are two scenarios in mind. You could see that actually happen to oil and gas prices right now. You do have this time this time window where you do see that actually happen. But we do believe it's just a matter of time that we're about to see a crash happen here in 2026, a deflationary crash, as we've seen it happen so many times in the past. And so we're quite conservative concerning oil prices right now. We can see some bullish momentum regaining strength as we've seen it happen here in the last few weeks. But you have to understand that we do see those liquidity cycles, and due to this empirical evidence that we've just assessed, we do believe we are quite late in the liquidity cycle. Also concerning the repo market problems we've seen in the end of 2025, concerning interest rate cuts, concerning the balance sheet expansion that happened also in the late stages of 2025. And so this is quite similar to what we've seen here previous to the COVID crash. And this for sure was not the best time to actually have a investment being made in oil prices. And so this is our conclusion for this video. I hope you liked the video. If you did, please make sure to subscribe to our channel and like the video. And also make sure to comment down below about your opinion, or if you have any questions, also don't hesitate to ask. Join our Discord server, which is also linked down below, so you can join our community even further and discuss topics with like-minded people. Thanks for your support. See you the next time. Bye bye.